So I wanted to give you guys a quick synopsis on really how real estate works, and why it's so entwined with the economy. It's crazy because I speak to a lot of real estate agents, and their real estate analysis stops at comparable. What sold last month or what sold in the last 6 months. And that's their determination of real estate and where the market is going. And we pay attention to all aspects of real estate, office, commercial, even industrial to that sense. But everything is predicated on the economy. And to really understand real estate at a deep level, you really got to understand the economy and how it works. So let's talk some basics here. And I'm going to try to keep this as layman as possible. But a lot of this stuff is somewhat sophisticated. But I want to make sure that you get the content and that you're able to really internalize it and understand what it means. I want to show you guys how and why real estate goes up. So a lot of people believe, hey, God created only so much land, and because there's only so much land, the real estate prices are going to go up. I do agree with the first part that God has created a limited amount of land on Earth, but it changes. But I'm not going to get into geography or whatever the subject is. But the reality is that we still have a lot of land that hasn't been developed. So the supply is there. So I can't completely agree with that theory. Here's really what happened. As we move forward in society, typically things or items that we make become cheaper. If you look at the cell phone, if you look at the flat screen TV, these items actually become cheaper to make over the course of time because we build an efficiency of how to make it, and we just get better at it. So our normal course of pricing is for things to actually start out at a very high cost and then get cheaper as we begin to mass produce it. So housing is really no different. There's a ton of land out there. It may not be in the center of on 42nd Street, but there's a ton of property and land out there to be developed and built, particularly in the suburban rural areas. So the efficiency of us building the houses, we've actually gotten better. And if you've looked at houses compared to, let's say, the 1920s, obviously the quality is nowhere near the same, but that's another issue. With that being said, the reason that housing prices goes up is because we're expanding the money supply. So it's not so much that housing prices are going up, it's more so that the value of the dollar, the vehicle that we're using to purchase those properties is actually going down in value. So why is the dollar going down in value? The reason is that we're printing so much of it. And because we've continued to expand the money supply, what we get or what we seem to get is inflation. Okay, so the technical definition of inflation is the expansion of the money supply. What we see, or the cause of that expansion, is increase in prices, and that's really what they pin the inflation on. So as the money supply expands, we start to see increase in pricing, and real estate happens to be a beneficiary of that. The question about real estate is, will we continue to increase the money supply? And obviously that is yes. So if it was that easy, we would obviously predict over time that real estate is going to be more valuable. And which is why we love real estate investment, because we understand if they continue to print money, then real estate is going to be more valuable tomorrow than it is today. Yes. And I say yes with a grain of salt, but in the short term, yes, that is correct. Now, what creates real estate bubbles is financing. The thing is that, not in addition to printing money, you've also created this extension of credit or debt. Credit is what allows or really exacerbates real estate bubbles. So here's what happens. I lend you $100,000 to buy a home. You pay it back over 30 years. Housing prices have gotten to the point where most people cannot buy a home without a loan. Okay, so the market is now determined, or it's warped around the availability of credit. It's not just debt. Demand anymore. It's also, is credit available to meet that demand? And that's a very intricate piece. And not only is the credit available, what's the cost of the credit, and who is it available to? So when we have an expansion of credit and increased money supply, real estate prices, and very low interest rates, the pricing of real estate is going to go up, because you have the pump going on. It's not intrinsic demand, but pricing is going to continue to rise because of that. If you take those factors away, you stop printing money, you don't have any credit, real estate prices are going to dip. The 2008-2009 recession was not caused by a dip in housing prices. What caused it is the defaults that were on those bad mortgages. It tightened the credit, so people were unable to get loans anymore. And if you look at the process of how credit started tightening, the first people to tighten their belt was Wall Street. Right? They stopped buying the mortgage-backed securities, which forced banks to stop lending, which forces housing prices to go down. And the reason they stopped buying was because defaults were mounting up on the loans that they had bought from those originators. So we have to pay attention to the availability and extension of credit. And that's what the Federal Reserve is doing right now. They're paying attention to the ease and availability of credit, because they know without it the housing market is going to tank. And the best way to ensure that there's a market for real estate and that prices will continue to go up is to make sure that there's credit in the marketplace. And the best way to do that from the Federal Reserve's perspective is to not only increase the money supply and allow inflation to happen, so that over time the bank's investment is better protected. And what I mean by that is, if you buy if you loan $100,000 on a property that's worth $150,000, if that property is worth $350,000 in 10 years, your loan is better protected over the course of time because of inflation, right? So it gives you an incentive to lend money. Moreover, it gives you an incentive to borrow money as well. You don't have to save and wait. You can own it now and get the appreciation. Back to what I was saying. So the Fed they stabilize the market by agreeing to buy mortgage-backed bonds, which allows banks to lend confidently, knowing that they have a buyer that's going to purchase the loans that they originate, which is going to, again, increase or stabilize the availability of credit, which will allow housing prices to go upward. Now, the issues that we're facing right now and that haven't been answered yet is that when you put eviction bans in place, there has to be somebody to pay for that. It's not just going to come out of the air. So either the Federal Reserve is going to print more money, which is going to cause inflation, or they're going to give money to landlords, or they're going to give money to municipalities or banks and allow them to not proceed with foreclosure. But the moment you have defaults and you have investors losing money and investors stepping out of the marketplace, you then have a downturn. And the reality is that although the Fed can support the market, they cannot be the market. And that's a really scary thing, because we're in a position right now that we're printing more money than we're making. Let me say it so we're printing at a faster rate than the money that the economic return that we're making as a nation. That's scary. And it looks like that trend is going to be here for the near future, because the Federal Reserve intends to continue to print more money. So unless the dollar completely collapses, which it I don't think it will in the short term, just because of our position as the world's currency. Real estate is going to bode well in long term, and then when I say long term, I would say within the next 5 years or so. In the immediate future, the thing that we have to look at and pay attention to are the amount of defaults that are in the marketplace, and defaults lead to opportunity. When you have a lot of defaults and a lot of foreclosures, and you have prices rising, that's not a sign of a market that's operating correctly. That's a sign of a market that's propped up, and that's a market that's also waiting for a correction. So even as these opportunities come to market, just pay very close attention to where you're taking advantage of these, and you obviously want to make sure that you're underwriting your properties based upon trends, historic trends, as well as where you deem we're at in the market as well. Interest rates obviously can't go any lower, so if they do start increasing interest rates, you ought to make sure that you're paying attention to that and underwrite your assets correctly. So again, this is G. Kelly Dixon, just giving you guys a little bit of how the economy works around real estate and some of the things that we're paying attention to as we move forward into the New World Order. All right, take care.